Welcome back to our lecture for Chapter 5, Short-Term Investments and Receivables. We are now on learning Objective 4. And with that, this is also on your test. So let's pay attention because we're actually going to use the allowance for doubtful accounts or uncollectible accounts. And this coincides with your Excel spreadsheets. So we sell on credit because customers can buy on credit. So hopefully that increases our sales and hopefully that increases our profits the more money we sell. But now there is a cost. There is no such thing as a free lunch. Everything comes at a cost. Companies cannot collect from customers. So that's what we're calling as an uncollectible account expense, or we also call that bad debt expense. You can call it either way. They're both an expense, so they both have a debit balance. So the allowance method is the only method allowed by GAAP, generally accepted accounting principles. And basically what we do here is we're recording the collection losses based on our experience and our history with the customers, right? So we record an uncollectible account expense to our income statement, or we're going to call it bad debt expense. And then we have an allowance for uncollectible accounts, which we also call allowance for doubtful accounts. Let's go back. For doubtful accounts. Allowance for doubtful accounts. We know that this is a contra to accounts receivable. So our accounts receivable we know has a debit balance. Our allowance for doubtful accounts we know has a credit balance because this is a contra AR account. And recall from the previous lecture, we said that sales discounts and sales returns and allowances, those were contra revenue accounts. And we're going to talk about depreciation, which is also a contra asset account. So keep that in mind. So the allowance method, here we see the balance sheet, and on the face of the balance sheet, this is our gross accounts receivable less our allowance for doubtful accounts. So right here, this 475 is our net realizable value. That is exactly what we're expecting to get in terms of cash. So this is the preferred method of recording it on the balance sheet. You can also record it simply in one line as a net amount, and we just say here that our allowance is 25. So then we know we have to add the 475 plus the 25 to get the 500. That's our gross AR balance. The previous method is this method is the method that we prefer. So we have two different ways to estimate this amount. One being the percentage of sales and two being the accounts receivable method. Since sales is an income statement account, we call that an income statement approach. It would be sales revenue, right? So depending on how much we sell, we're saying that a percentage of that is going to be uncollectible. Now, AR, aging of receivables, we know accounts receivable is on the balance sheet, so as an asset, so this is our balance sheet approach. So you should have these formulas in Excel as well. So here you know the percentage that you expect times the sales revenue. This gives us our uncollectible account expense or our bad debt expense. Okay, so now let's go work through an example. So if we're doing percentages of sale, we're talking about Apple before the year end. This is our balances in accounts receivable, and this is our balance in allowance for doubtful accounts. And so here we're saying that we assume the credit department has uncollectible 0.0005. Now remember, if you move this over, this would be 0.05% in Excel of total revenues, and we say that our total revenues is this. So you're going to take in Excel your 156,508 million, and you're going to multiply it by 0.05% to get the percent of sales that is not collectible, which hopefully you'll get 78. So here we have our uncollectible is our 158,508, and we're going to multiply that by 0.05. And if we move that over, then we just add that 0.05%. This is going to go to uncollectible account expense. You can also call this bad debt expense. Either way, both are correct. Allowance for uncollectible accounts or allowance for doubtful accounts. But basically, you're going to debit the bad debt expense and you're going to credit the allowance. And then here's what this was your beginning balance, right? And then here's your beginning balance and notice the 78, this is the amount of the journal entry, right? So the journal entry and the amount that we're booking is the same, right? So this is very important in the percentage of sales. So you want to say the calculation here is what gives you your journal entry amount. You do not have to worry about the allowance for doubtful accounts beginning balance with the percentage of completion method. As you can see, the 78 we recorded here is the 78 that we're adding. That's what's showing on our uncollectible or bad debt expense. Now, with the allowance method on the aging of receivables, we have a similar formula, except instead of this being percentage of sales, we're looking at our AR balance. So we still have the same information as we did before, but now what they're telling us is that we're going to have 98 million that is not collected. So here you see an aging. This is called an aging report of accounts receivable, AR aging. Then you see the categories of terms. These are, we call them buckets or categories, right? And each customer that owes us, we have a balance. And this means that it's current, or 1 to 30 days past due, 31 to 60 days past due, 61 to 90 days past due, and greater than 90 days past due to get our total balance. So here's our total AR balance. And then as you can see, the estimates get greater, right? So here you have 0.75%, 1% for anything greater than 60 days, about 5% for anything between 60 and 90 days, but anything over 90 days is 10%. So once you compute this, and you'll see here that this is rounded to the nearest dollar. So if you do it in Excel, just make sure that you reduce the decimal places. So you get 98 million here. That's how this amount was determined. This 98 was determined by taking each bucket of our AR aging, multiplying it by an estimated percent that we feel is uncollectible. Obviously, the longer that it's past due, the less likely we are to collect it, so that percentage has to be greater. Then once you get the totals for each, you add it up to get your full total. But now in your full total, you've got to take into consideration the balance in our allowance for doubtful accounts, right? When we go back here, we see we had 10 million in here as a credit. So because of that, we've got to make sure that we are now booking 88 million, right? Because we calculated this is what our ending balance should be. So in this case, you're going to do the same journal entry, right? You have uncollectible account expense or a bad debt expense for the 88, and then you also have the allowance for doubtful accounts for the 88. So the key in this piece is, the key here is you have to make sure that your entry, so here you're going to say aging of receivables, journal entry equals the ending balance of allowance for doubtful accounts. So you know that this is what you calculated, so you have to take into consideration your beginning balance. And notice that your expense will not correlate like it did, or will not equal like it did for the percentage of sales method. And then you see the net receivables, it takes our account and divide, and so you see 11,028,000, and when we subtract the 98 million, we get 10.930. So now we are going to move into our writing off an uncollectible account. So we know now we have these accounts receivable in these amounts in particular, right? So we have here so these are the sub-ledgers of these two individuals. And basically, that's our 11,028,000, right? Everybody else is in here. So these are our two particular gentlemen. And we still have our net, right? So here's our 98 right here. So everything is exactly as we did it previously. But now what we're saying is that RS is basically, and if we go back, you see RS has 9. So RS is not going to pay us. He cannot pay us. So in this case, what you're going to do is you're not going to hit not bad debt expense here, because this is the allowance method. You're going to hit the allowance for doubtful accounts. You're going to reduce it because it's a debit balance, and then you have to specifically credit the accounts receivable balance because you are writing it off. So don't get confused here. Here what you have is that you have his particular account, right? It has to be written off. So we're going to take the 9 out of that, and we're going to take it right from his account. So you see we're of the 98 here, we're reducing it by 9 because we know specifically we have to write his account off. He's not going to pay us. So So in a direct write-off, using the allowance method, your credit is usually accounts receivable and your debit is allowance for doubtful accounts. Do not get that confused with the percentage of sales method. So now, after the write-off, you've eliminated him, right? He's got a balance of 0. So now you have and then basically you still have your totals here, but it's just you particularly wrote it off. So if you look at it, it's the same net. So if you look here, the amounts are the same. All you're doing in this case is you had it, oops, sorry about that. Oh, let's see what happened. Oh, that's not getting down here, huh? Oh, there we go. Perfect. Sorry about that. So here, let's go back to this. So you see there, the equal. So only thing here, we had 98 million, and now since we took 9 out, it's reduced, but the ending balance is the same, because all you're doing is taking it from accounts receivable, and you're just taking it away from allowance for doubtful accounts. So as long as they equal, we're good. So the easy way here is that your percentage of sales, right, this adjusts. So here you get the amount of your journal entry is the amount of the expense. In this case, in the amount of your journal entry is your balance in allowance for doubtful accounts. So now let's walk through an example here. So here we have on November 30th that we have a $34,000 balance in AR and a $3,000 credit balance in allowance for doubtful accounts. Make sure you read that $3,000 credit. You may start with a debit balance. So now during December, they had credit sales, and that's what you want to see. You don't need cash sales because cash sales are collected in cash. Right, so we have credit sales of $159,000, and then our December collections on account were $130,000. Then we wrote off uncollectible accounts of $2,700. Now we are using an uncollectible account expense of 1% of credit sales. So that 159, we're going to multiply it times the 1%. So what we are required to do here is we are required to have the journals for sales, collections, write-offs, and uncollectible accounts, and we don't need to give explanations, so that's great. And then we need to show how we would report accounts receivable and net sales on its balance sheet and income statement. So there's a lot going on here, so let's get started. So we made credit sales of $159,000. So that's accounts receivable. We're going to debit that for $159,000 in sales revenue. We made sales. We did our party planning. We got money. Now we collected $130,000. So that means our cash is going up for $130,000, and we're going to reduce our accounts receivable balance. So now if we're looking at our accounts receivable here, we had $159,000, right? And then we had $130,000. So right now our balance in our accounts receivable is only $29,000. Okay, and now we wrote off uncollectible accounts totaling $2,700. You want to make sure here you do the allowance for doubtful accounts of the $2,700 and then the accounts receivable balance itself. Right, so in this case, we're going to add that here. So this is the activity so far in our accounts receivable T account that we'll see coming up. Right, so here is our sales. We have this amount, and here was our $130,000, and this was our direct write-off. And our beginning balance, I believe, was this amount. So we have our beginning balance. This is our credit sales here, our direct write-off, and this is our cash payments. So now we have that we need to actually record our uncollectible account. And then don't forget that our uncollectible account, whatever balance we come up with here, which is basically our 1%, right, of our 159. So we're going to take that 159, multiply it by 0.1 to get the 1590 or 1%. Right, then we're going to do that. We're going to debit uncollectible account expense or bad debt expense, and we're going to credit our contra revenue account of 1.5. Now here we see this was our beginning balance. Here is our direct write-off. And then now we have our bad debt expense. So we have our balance here. So now you see what each T account looks like. So now to go to our second part of our, so then all you have to do is take your balance, right, minus that, and you get your net realizable value of your accounts receivable. And then the second part asked us how we would do this. So that's our 6,300. So if we come right here, and then this is going to be the 1890 is going to be our balance in less allowance for doubtful accounts. And then here's our net sales, the 159. Don't get confused. Remember, this is an accrual basis based on our previous chapters, so you don't enter the cash, right? That your net sales is recorded at the 159, not the 29. So now the direct write-off method, here you're recording your expense when the customer account proves it to be uncollectible. This is not GAAP, right? Because there's no allowances for uncollectible, so your receivables may be overstated, so we don't require this for GAAP. What we use this for is mostly tax purposes, okay? But you should know how to do it, right? So instead of in the allowance method where we had right here the allowance for doubtful accounts, we're going to book it here to bad debt expense for the 9, right? And then when you have your computing your collections from customers, you're going to have your sales on account as your lesser amount. So don't be too hung up on this. It's the allowance method that's important. And then our allowance for uncollectible accounts is deducted when we're actually writing it off as well. So, and then your cash collections are all there. So it's all the same entries, just a little differently. The key is that we're not matching revenues with expenses here. What we're doing is we're recording everything to accounts receivable. There is no allowance account. And since that isn't GAAP, we're not really too worried about that. So that right here, we'll stop right here, and then we will pick up in our next video lecture on Learning Objective 5.